Dave Barnett from the investlocalbook.com blog site, and I wanted to make a little video today about dead capital. I was hired recently to do an evaluation of a small town diner. And, restaurants are a competitive business. And if any of you have read the book E-Myth by Michael Gerber, you understand the difference between a technician and an entrepreneur. Someone who knows their trade and somebody who is getting into a business. So, how do I describe dead capital? Let's look at something that most people could understand. If you bought stocks on the stock market, let's say you bought shares of the telephone company and you paid $10 a share, and then the price was moving up and down and up and down, and then you looked on the internet one day and you saw that the price of the telephone company stock was $6. Everyone understands you lost $4. You paid $10 for the shares. At that moment, there's nobody out there willing to pay you $10 for the shares because they're worth $6. What happens in small businesses is that people will get into a business. So, for example, in the case of this small town restaurant owner, he leased a location, spent $150,000 on equipment, furnishings, flatware, cookware, some leasehold improvements, opened up his restaurant. So it's just like the day you buy the stock in the telephone company, this is the price you paid today. So he bought the stock in his company for $150,000. That's what he put into it. He then opened his doors and started to serve clients and started to create a cash flow. So when I come in and I evaluate the value of a business, what I'm interested in is cash flow. And for larger businesses, we're looking for EBITDA, which is the true cash flow after a manager has been paid. So these are businesses that have sales in the millions of dollars, that have earnings in excess of $500,000. For small businesses, we want to look at the seller's discretionary cash flow, or seller's discretionary earnings, SDE, is often how you see it. So, and that's because in small businesses, people aren't only buying, for example, a restaurant because they want to make an investment. Most buyers of a restaurant are also buying themselves a job. They're going to be the manager, owner, operator of the restaurant. So when you look at the combination of the owner manager's salary plus the profit of the business, that is your seller's discretionary earnings, the amount of money available to the owner who works full-time. And so just like in bigger companies where we multiply EBITDA, in smaller companies we multiply SDE, but the multiple factors are significantly lower. So if you were to have an SDE of $50,000 and you were in the restaurant trade, you might be able to sell your business for a multiple between 1.1 up to 2.3 max. So let's say 1.8. So you earn $50,000, seller's discretionary cash flow. Someone's willing to pay you 1.8 times discretionary earnings, and so you got a business now that's worth $90,000. So when I do my evaluation, I go through the cash flow and I figure out what would a person who has a little bit of money, they want to buy a business, they also need to buy a job because they need to have a family income, what would they be willing to pay for this kind of business with this cash flow? That's the question that I'm trying to answer through my process. And so I go through the process, and I got to tell you, I've had this conversation 50 or 60 times over the years. Because what will happen is I'll come back in, like with this small town restaurant guy, and I'll say, the most probable selling price of your business, in this case it was $117,000. which means you should probably put an asking price of like $149, and you're going to negotiate down from there. And of course, he gets upset, calls bullshit, says I don't know what I'm talking about. Why? Because it cost him $150,000 to build the place, right? And so I call this having dead capital trapped in the business, because what has happened is there is money that the owner has put into the business which is not generating any kind of return at all. The capital essentially is dead. The big difference, though, between the stock market example I started with and the case of a small business is that you do have an opportunity to resuscitate the capital. When you're talking about the telephone company stock, as a small investor, I don't really have any way that I can influence or impact the price of a stock, right? Big investors might if they're buying and selling big blocks of shares, but little guys, no. Wherever the market goes, that's where it's taking us, and we just choose to buy and sell. But in a small business, what I said to this guy, and he wanted $250,000 for his business, and I explained to him how no one would be willing to pay that and why. Because essentially they would be indenturing themselves for 5 years of free labor before they ever got any of their money back. And nobody would do that in a business as risky as a restaurant. And don't forget, we're talking about multiples of discretionary cash flow, which means we're not talking about taking a salary for your labor and then taking 4 or 5 years for the profits to pay you back. We're talking about a combination of your wages and profit taking 4 or 5 years to pay back. No one's going to do that. And then I explained to him how he could get $250,000 for his business. And essentially what it comes down to is he's got to figure out how to grow the business so that he can get a discretionary cash flow of like $125,000 or $130,000. Then he won't have any trouble finding people willing to pay $250,000 for his restaurant, because people will pay that kind of money to secure themselves a personal income of like $130,000, right? I mean, here's a great example, because sometimes I run into bankers who scoff at the notion of paying money to buy a job. And when they say, it's ridiculous to pay money to buy a job, who would do that? The very next question that comes out of my mouth is, well, how much did you pay for your MBA? Because that's essentially what people do when they're buying education. They're putting up big money today, investing years of their life in exchange for the idea or the hope that they're going to be able to earn more money in the future. Essentially, when you buy an education, you're buying yourself a job. The big difference in the risk profile of these two propositions, though, is that when you buy a business that has a cash flow associated with it, you pay your money and you get to enjoy the cash flow today. When you buy an education, you're gambling on the idea that there will, in fact, be a job available for you at the end of the day when you head out into the workplace. Anyway, thanks a lot for watching. If you want to learn more about local investing and how to invest in local businesses while avoiding a lot of the risks of being in business, you'll want to read my book, Invest Local. It is available on Amazon in both softcover and Kindle, as well as in PDF form from my blog site, investlocalbook.com. Thanks. Have a great day.